Welcome to Money Minds. Are you looking to trim your portfolio risks? In the world of investments, risk management is a cornerstone. It's the fine art of balancing potential rewards against the risks. See, not all stocks are created equal. While some offer attractive returns, others can be akin to ticking time bombs, capable of inflicting significant damage to portfolio. The truth is, successful investing isn't just about picking winners, it's also about avoiding potential losers. And in the vast sea of offerings on the Nasdaq, there are certain stocks that carry a level of risk that could potentially outweigh their prospective returns. Whether it's financial instability, declining sales, or over-optimistic projections, these stocks, though they may seem promising, could be more of a liability than an asset. So as you navigate the complex waters of the investment world, it's crucial to stay informed and make decisions that protect and grow your capital. Let's delve into 3 Nasdaq stocks that could be heading 6 feet under. First on the chopping block is Canopy Growth. A name that's been making waves in the cannabis industry, Canopy Growth has, however, been facing some severe financial turbulence. So, what's the real deal with Canopy Growth? Let's dive into the nitty-gritty of it. Canopy Growth's primary issues are its losses and mounting debt. Despite the burgeoning cannabis market, Canopy Growth has been struggling to keep its head above water. The company has been posting losses, which is a significant red flag for any potential investor. When a company is in the red, it means it's spending more than it's earning. Now, that's not a sustainable business model, is it? Let's not forget about the debt. Canopy Growth has been piling up debt like there's no tomorrow. High debt levels can be alarming because it means the company is not generating enough cash and is relying on borrowed money to fund its operations. This puts the company in a precarious position, especially if it continues to post losses. These financial weaknesses pose serious risks to investors. The company's losses indicate that it's not profitable, and its high debt levels suggest that it might struggle to stay afloat in the long run. This could lead to lower stock prices in the future, which would mean a loss for investors. Moreover, as an investor, you want to put your money in a company that has a solid financial foundation. A company that is making profits and is capable of managing its debt effectively. Unfortunately, as it stands, Canopy Growth doesn't seem to tick those boxes. Given these red flags, Canopy Growth could be a stock to consider removing from your portfolio. It might be a risky pick, and as savvy investors, we must always be on the lookout for such high-risk and overvalued picks. Remember, the goal is not just about making profits, but also about preserving capital and minimizing losses. Next up is Beyond Meat. Now, Beyond Meat has been making waves in the food industry with its plant-based alternatives to meat products. However, beneath the surface of this seemingly promising venture, the company has been grappling with some significant challenges. One of the key issues that has been plaguing Beyond Meat is its declining sales. After a period of meteoric growth, the company's sales have been on a downward trajectory. This is a concerning trend for any company, but it's particularly troubling for a young, growth-oriented firm like Beyond Meat. Declining sales can hamper the company's ability to invest in research and development, marketing, and other critical areas of the business. But the sales slump is just one piece of the puzzle. The company also carries a heavy burden of debt. High debt levels can be a double-edged sword for businesses. On one hand, debt can provide the capital needed to fuel growth. On the other hand, if not managed effectively, it can lead to financial instability and even insolvency. In the case of Beyond Meat, this high level of debt is adding to the company's financial woes. It's not just about paying back the borrowed money, but also the interest that accumulates over time. This financial obligation can divert resources from other areas of operation, potentially stifling growth and innovation. Moreover, the combination of declining sales and high debt raises questions about the company's financial stability. It's important to remember that stocks aren't just pieces of paper, they represent partial ownership in a company. As such, the financial health of the company is directly tied to the potential returns for investors. In the case of Beyond Meat, these financial challenges could potentially impact the company's ability to deliver strong returns. Investors need to be aware of these risks and weigh them against the potential rewards when making investment decisions. With these concerns in mind, Beyond Meat might be another stock to consider trimming from your portfolio. Last but not least, we have QuantumScape. QuantumScape, another Nasdaq stock, brings us to the quantum realm of risk. This is a company that, despite its futuristic technology and high-profile backing, has yet to generate any significant revenue or earnings. It's a story of promise and potential. but currently, it's one that's written more in hopeful projections than in hard numbers. QuantumScape is banking on a battery technology that could revolutionize the electric vehicle industry. It's a thrilling prospect, no doubt, but it's also one that's yet to prove itself on a commercial scale. The company is essentially asking investors to buy into a vision of a future where its solid-state batteries power the electric cars of tomorrow. That's a big ask, especially when that vision is yet to translate into tangible financial results. The lack of revenue and earnings is a glaring red flag for any investor. It means that, for now, QuantumScape is burning through cash without generating any of its own. This is a precarious position for any company to be in, and it places a heavy burden of risk on the shoulders of investors. Moreover, QuantumScape's valuation is largely built on hope and optimism. It's a speculative bet on a future that may or may not materialize. This is not to say that QuantumScape won't succeed, it might. But the road to success is fraught with challenges and uncertainty, and investors must be prepared to navigate this treacherous terrain. So while QuantumScape's vision is undoubtedly exciting, it's important to remember that investing is not just about chasing potential. It's also about managing risk. And right now, the risks associated with QuantumScape are substantial. Given its precarious financial situation, QuantumScape could be a risky bet for your portfolio. Investing always involves some level of risk, yet it's crucial to recognize when a risk is not worth taking. We've examined 3 Nasdaq stocks that are currently displaying significant financial weaknesses: Canopy Growth, Beyond Meat, and QuantumScape. Canopy Growth is battling losses and debt issues, a scenario that could potentially lead to a financial downfall. On the other hand, Beyond Meat is grappling with dwindling sales and a mountain of debt, which are red flags for any investor. QuantumScape, despite its optimistic future projections, currently lacks revenue and earnings, making it a risky gamble. Navigating the financial markets is not just about finding the next big winner. It's also about understanding the importance of risk management in investment decisions. This includes recognizing when a company's financial health is deteriorating and when it's time to divest. In the ever-evolving world of investing, one thing remains constant: the need to balance potential rewards against potential risks. It's not just about the stocks you decide to buy, but also the ones you choose to sell. Remember, trimming your portfolio risks isn't just about picking winners, but also about knowing when to cut loose potential losers. In today's discussion, we've looked at 3 Nasdaq stocks that could be heading 6 feet under. We began our exploration with Canopy Growth, a company that, despite its promising beginnings, is now facing significant financial challenges. With mounting losses and debt issues, this stock has shown that it may not have the resilience or robustness to withstand market fluctuations. Next, we delved into Beyond Meat, a company that once was the darling of the market with its plant-based meat alternatives. However, the company is currently grappling with declining sales and high debt. This combination has raised concerns about its future viability and its ability to deliver return on investments. Lastly, we examined QuantumScape, a company that is heavily reliant on optimistic projections, yet lacks tangible revenue and earnings. This glaring discrepancy between forecasted growth and actual performance raises a red flag, making it a potentially risky choice for investors. These 3 stocks, Canopy Growth, Beyond Meat, and QuantumScape, are examples of companies that, despite their potential, carry significant risks. As we've seen, overvaluation, financial instability, and a lack of revenue and earnings can turn promising investments into financial pitfalls. In the complex world of stock market investing, it's important to remember that not all that glitters is gold. While some stocks may appear attractive on the surface, a deeper dive can often reveal underlying issues that could impact their future performance. As always, it's crucial to do your own research and consult with a financial advisor before making any investment decisions. Until next time, stay savvy, investors. That's all we have for today's deep dive into Nasdaq's risky trio: Canopy Growth, Beyond Meat, and QuantumScape. We hope that this analysis and discussion will aid you in making informed decisions when it comes to your investments. Remember, the world of investing is not just about chasing potential profits, but also about understanding and managing the inherent risks. It's about finding the balance between risks and rewards, and making the right decisions at the right time. We're here to help you navigate these complex waters with our deep dives into various stocks and investment strategies. If you found this video helpful, don't forget to hit the subscribe button. We regularly upload insightful content aimed at helping you become a more savvy and informed investor. Make sure to turn on notifications so you don't miss our next video. Until then, happy investing, and remember, not all that glitters is gold. Stay savvy, investors.